Nike, ticker NKE, is a company that all of you probably know, and over the past 5 years it is down by 17.21%, and over the past year it's down by almost 30%, very near its 52-week low. And so today I want to show you exactly why Nike is currently extremely undervalued and why buying it at its current trading price will yield you great return. And to do this, we will use our stock valuation spreadsheets where we will have a look at the fundamental 9-pillar analysis and calculate the intrinsic value of Nike using the 4 valuation models. Now, first of all, we have to plug in Nike's ticker into the stock screener. So we will plug in NKE and wait for all the metrics to show up. Now, one thing I really love about Nike is its very low trailing free cash flow payout ratio of only 33.89%. And this means that after paying out their dividend of $1.48, they still have about 65% of their free cash flow left over to buy back shares, pay off debt, and raise their dividends while investing back into the business, which is extremely important with every dividend paying company. Now, jumping to the 9-pillar analysis, we can see that the rating for the 9-pillar analysis is actually sitting at 7 out of 9, which is a very decent rating with only 2 pillars in the red. So the first pillar in the red is the 5-year PE ratio, and we want that to be anywhere below 22.5, and we can see that for Nike, on average, it has been sitting at 29.57. And that's the same case with the price to free cash flow, which is sitting higher than what we'd like to see. But if we jump to pillar number 1 and have a closer look at the 5-year PE ratio, we can see that over the past 5 years, it has been sitting on average at 29.57, but it has been decreasing at a rate of 9.54% every single year, and currently it's sitting at 22.18, which would be considered slightly undervalued compared to their earnings. And if we have a look at the second pillar, which is the price to free cash flow over the past 5 years, to be sitting anywhere below 21, we can see as well that that has been decreasing at a rate of 11.61% and is currently sitting at only 17.88. So when the price to free cash flow and the PE ratio are lower than the averages, it means that the investors are underpaying for the company's net income and for their free cash flow, which gives them much more space for a much larger return. But now let's see how Nike is growing. So we can see that their revenue has been growing at a rate of 6.25% yearly over the past 5 years. Their free cash flow has been growing at extreme rates as well, and their net income has also been growing at a rate of 24% every single year over the past 5 years. And so if we have a closer look at their growth, we can see that indeed their revenue has increased from 37 billion in 2019 to 51 billion in 2023. Regarding their net income, that has increased from 2.5 billion in 2019 to 5.7 billion in 2023. Their free cash flow has increased from 1.4 billion in 2019 to 6.6 billion in 2023. And so even though many investors are scared of Nike's competition coming from China, we can see that the company has been growing at extremely good rates. Now let's have a look at the remaining pillars. So we can see that the 5-year profit margin is currently sitting at 44.50%, which is well above the 10% we'd like to see. We can also see that Nike has been decreasing their shares outstanding at a rate of about 0.9% every single year over the past 5 years, which hints that they know that they are undervalued and therefore they are buying back shares while they are trading cheap. It's also a great thing, as when there are less shares outstanding in the market, you essentially own a larger percentage of the company and therefore your shares have a larger value. Another great thing about Nike is that over the past 5 years they have been raising their dividends consecutively at a rate of 9.22% yearly. And if we have a closer look at the consecutive dividend growth, we can see that that is twice as much as the average S&P 500 company. But we can also see that year over year they only grew their dividend by about 2%, so that is something we have to take into account when plugging in the growth rate for our dividend discount model. And moving to the final pillar, the long-term liabilities over the 5-year free cash flow negative dividends to be below 5. And this tells us whether the company generates enough free cash flow to pay off all their long-term liabilities while paying off their dividends. And we can see that this pillar is in the green for Nike, sitting at a ratio of 0.94, which means that they can pay off all their long-term liabilities in about 5 years. So they won't be getting into trouble with debt anytime soon. So overall, we can see that Nike is doing extremely well. They are growing at very high rates while being undervalued compared to their earnings and their free cash flow. They also have great consecutive dividend growth and almost no debt at all. And so now let's calculate their intrinsic value, first using the Graham's formula revised. And here we use the formula laid out for us by Benjamin Graham to calculate the intrinsic value of a stock. But before that, we have to calculate the 5-year earnings growth estimate. And to do that, we plug in our high earnings per share growth estimate, which I plugged in at 20%, our medium earnings per share growth estimate, which I plugged in at 12%, and our low earnings per share growth estimate, which I plugged in at 8%. And all these predictions are based on the research I did in the back end and our 9-pillar analysis. And based on these growth rates, we calculate an earnings growth estimate of 14.34% yearly over the next years. And after using the formula and plugging in all these values, we calculate an intrinsic value of $89.10, which is 13% higher than the current trading price. Now moving to the next valuation model, the discounted cash flow model. And here we take the free cash flow of the company over the past 5 years and calculate the average growth rate. Now to calculate the future growth rate, we use the same method as we used in the Graham's formula. We predict the high free cash flow growth, the medium free cash flow growth, and the low free cash flow growth, and get a calculated growth rate of 14.7% into the future, which we then use to calculate the future free cash flow. Now to calculate the present value of the future free cash flow, we need the discount rate. And the discount rate is essentially the minimum rate of return you want from your investment. So I plugged in a high return of 18%, a medium return of 12%, and a low return of 8%, and combined that with the WACC to get a discount rate of 8.7%. And using that, we calculate the present value of the future free cash flow. And then we sum all of that up, add cash and cash equivalents, and subtract total debt to get an equity value, which we divide by the shares outstanding and get an intrinsic value of $168.88, which is much higher than the current trading price, showing us that Nike really has very strong free cash flow growth. Now moving to the next valuation model, where we compare Nike to its competitors, so Deckers Outdoor and Skechers. We take these companies' current stock prices and divide by their earnings per share to get their PE ratios, which we then average out and multiply by the earnings per share of Nike to get an intrinsic value of $85.55, which is slightly higher than the current trading price, showing us that Nike might be undervalued compared to its competitors. Now moving to the final valuation model, the dividend discount model. And here we take the dividend payouts over the past 5 years and calculate the average growth rate to be sitting at 11%. Now to calculate the projected growth rate into the future, we use the same method as we did before. We calculate the high growth rate at 11.5%, the medium growth rate at 8%, and the low growth rate at 3% yearly. And we get a projected growth rate of 7.5% into the future. And with this projected growth rate, Nike's intrinsic value is $130.89. And now moving to our ultimate valuation, where we average out the 4 valuation models, we will switch the alternative dividend discount model to the dividend discount valuation and get an intrinsic value of $118.60, which is 53.24% higher than the current trading price of the company. And if we plug in a margin of safety of 20%, we still get an acceptable buy price at $94.88. And so this shows just how much Nike is undervalued, and that in the upcoming years the company won't have any issues returning more than 50% of the initial invested value. And with that, I hope that you enjoyed the video. Let me know down in the comments which company you'd like me to evaluate next, and leave a like and subscribe as it really helps me out.